Aloha mai kako. You are watching Hawaii Political Reporter.
Aloha and welcome to Hawaii Political Reporter. Thanks for watching. Tonight, banksters plunder the people. Why the gold sell-off was a direct result of financial manipulation by central banks and their controlling megabanks to consolidate their power and financial strength by eliminating lesser banks, indenturing nations and their people, and acquiring gold and other assets on the cheap. James Corbett, James Pilato, and Aaron Hawkins give us a breakdown of important economic and financial news and the schemes and manipulation behind them.
With our friends at blacklistednews.com and return to Cyprus, who's about to sell 400 million euros worth of gold, about 75% of its holdings, to finance part of its bailout. And this comes via zero hedge. Curious why every bank and their grandma, and even most recently Goldman Sachs today, April 10th, 2013, has been lining up to push the price of gold as low as possible? Here's why. Cyprus to sell 400 million euros worth of gold reserves to finance part of its bailout. Congratulations, Cypriots. You are now handing over your gold for the one-time, unbeatable opportunity to remain a vassal state to the Eurozone. Hey, but at least you have your euros left. The good news is Cyprus will have at least another 4 or so tons after selling the 10 tons demanded now, before the Troika kindly requests that Cypriot citizens sell a kidney or two to pay for the ongoing deposit outflow from its insolvent banks and indirectly the endless bailout of the euro. James will also include the original Reuters piece for this story, and I find it interesting, James, that this week is also the 80th anniversary of Franklin Delano Roosevelt's Executive Order 6102 banning gold ownership here in the States. So again, we talk about stories internationally to show folks what may happen here or what may happen there. James?
Yeah, I noticed that 80th anniversary myself this week and thought that was pretty ironic with the timing of all of this. But yes, interesting story, isn't it? And it just once again goes to show that there have been major attempts at suppression on the gold market in recent months, and it certainly does seem to be adding up to this central bank buying spree that I think we're going to see after this selling spree from Cyprus. And it's not going to take an Einstein to figure out where this gold is going. It's going to go to the same central banks that have been buying at a record pace in the past few years. And I think last year was something like the most amount of central bank gold reserve buying since the 1960s, I believe it was. I don't have the number off the top of my head, but it's certainly been a frantic buying spree. And I think China and Russia, at any rate, will be willing participants in the buying of this gold. So again, people like Kyle Bass and others have come out recently talking about how they're mystified by how gold is just not going up the way that it seems like it should be. But I think we shouldn't be mystified by that. We should realize this is just part of the manipulations that are going on right now, and it's related to events like these, where Cyprus is now being held at gunpoint to get rid of their gold holdings. So the Cypriots are just keep getting getting kicks and punches and sticks in the eye, and it's just really deteriorating there quickly. So a very interesting development, and I'm glad you picked up on this.
One other related note I'll add, James, and I think it's something that seems to be kind of bubbling under the surface, is this alleged inevitable crash of Bitcoin.
Today, gold experienced its largest two-day drop in 30 years, crashing through its support at $1,400 an ounce. Silver also dropped sharply, losing 6% in a single day. And Bitcoin fell through the floor, shedding 70% last Thursday. All while the stock market is showing signs that it too is in a bubble and is likely to face a serious correction in coming months. So what's really going on here? Many are saying that the gold crash was sparked by the indications that Cyprus may be forced to sell off its gold reserves and by fears that this policy may be implemented throughout Europe. Others say that the drop in gold and silver is all being orchestrated by the Federal Reserve and other banking interests to protect the dollar. Those of you who follow precious metals have probably heard this explained as being driven by the dumping of gold and silver ETFs, which are paper assets not backed by any physical commodities. However, if you take a step back and look at the trends that are developing across the entire market, what we see points to a deeper underlying cause. The first question you should ask when looking at the run-up to these crashes is what was driving the investment in the first place? Was the upward movement in the markets representative of an actual improvement in the economy? Or were these movements in sync with the situation on the ground? Well, no, not at all. In fact, the disconnect between the speculative and investment markets and the real-world economy has been growing, and a number of experts have been talking about this trend for some time now. Not surprisingly, some of the heaviest hitters in the investment world, including Warren Buffett and George Soros, have been quietly exiting the US stock market, and many corporate insiders have been selling their stocks instead of buying over the past several months. Now, obviously, when it comes to precious metals, this dynamic is more complex. There's a difference in the investment mindset because it's viewed by many as a hedge against inflation and a sort of safe haven to protect wealth during a downturn. And you also have a number of countries like China buying it up in large quantities. However, this does not make it invulnerable to market forces. If people start selling in mass, the price drops. This is crowd psychology, just like a herd of buffalo that panic and run off a cliff. It doesn't have to be rational at all. When it comes to gold, we do have some real world limits because it currently takes $1,200 an ounce just to get it out of the ground. And mining companies aren't going to sell at a loss, so the price will stabilize somewhere above that mark in the long term. Now, we really can't discuss the upsurge in any kind of investments without looking at the Federal Reserve's quantitative easing policies. For those who don't know, quantitative easing is basically a fancy word for inflating the money supply. We used to say that they were running the printing presses, but nowadays they don't even print the money, they just type it into existence. We've had QE, QE2, QE3, QE4, one after another flooding the market with dollars in a desperate attempt to prop up the economy. Now, this hasn't led to an inflationary tailspin because of the petrodollar, and that has resulted in a break from the historical relationship between the money supply and gold prices. Those who don't take the petrodollar into account have a very difficult time explaining the way commodities have been behaving for the past 5 years. The fact that oil is only sold in dollars is spreading out the consequences of US monetary policy across the globe, making it much less noticeable to the American public, and distorting the way that they behave in the markets. If you were using the stock market as your point of reference, all of this quantitative easing seemed to be working. But again, the real world economy has not been rebounding. And what that means is that what we've been seeing are speculative bubbles fueled by the influx of cash. Whether we're talking about the stock market, precious metals, or bitcoins, these upward swings have been investment oriented. Obviously, people are more likely to invest when more money is available to spend. And as the money supply grows, so does investment of all kinds. The problem is that in the United States, most of the investment that we've been seeing hasn't led to real increases in jobs. And when investor enthusiasm surpasses productive returns and real-world demand, a correction is inevitable. Once you're in a bubble, almost anything can spark a correction. People have been giving a lot of attention to the Cyprus angle, but it's worth noting that these crashes just happened to occur during the build-up to tax day in the United States. Could it be that people were selling bullion and bitcoins to cover their income taxes? The reality is it could be a combination of factors. These kinds of market movements are often not traceable to a single cause. Multiple variables can influence market sentiment and coalesce into a panic. Again, markets have to be looked at in terms of human psychology, because in the end it all comes down to perceived value. This entire system is a construct of belief. Those who become attached to a concept of the absolute value of an asset open themselves up to severe losses. So does this mean that people should sell all their investments and stick to cash? Well, some people will promote that idea, but the dollar and the euro are both headed for a collapse. And once that happens, all bets are off. In the short term, gold will not go below $1,200 an ounce for any significant period of time, and it will most likely rebound in the next few months. After the collapse, who knows what gold will be able to buy? That would really depend on what people decide to use for exchange. It could very well be that tobacco would be the currency of choice. It's really impossible to predict that kind of thing. So what's the solution for the average Joe who doesn't have the resources to buy at companies in emerging markets or to set up elaborate hedging strategies, or who doesn't even have the resources to buy any meaningful quantity of gold or silver? I'm not here to give you investment advice, but my personal opinion, we need to pull out of this speculative mindset and start thinking towards an alternative economy. When we're talking about a real economy, it's the means of production that count, not the unit that you use for currency. People need to be looking towards things that they can produce in their own homes, which will be useful during a crisis. We need to grow gardens, we need to be building up connections and relationships in our local area with people with the same mindset. Buying up assets which you hope will increase in value is not likely to do you nearly as much good in the long run as building alternative means of production and exchange. Obviously, this isn't an easy answer, and it may be next to impossible in some neighborhoods just due to the mindset of the public. But realistically, what other option do we have? In the speculative markets, the little guy never really has a chance. If we try to compete with the elites on their terms, we're going to get eaten alive. We have to stop playing their games, and any investment strategy tied to their current monetary system is still their game.
As the major stock indices hit new record highs, many are left wondering how such a bull market can develop while the average worker faces layoffs, lower wages, and rising costs. The answer presents itself in the documented, admitted, and openly acknowledged manipulations of the markets by governments, central bankers, and financial institutions. This is the GRTV Backgrounder on Global Research TV. In the age of quantitative easing and overt government intervention in the economy, it's impossible to trust any of the economic statistics that we are being shown as indicators of the supposed health of that economy. Whether it is GDP numbers, manufacturing data, inflation statistics, or housing figures, all of the macroeconomic data that drives the financial news agenda are manipulated to suit the propagandistic purposes of the government and the central bankers. A striking case in point presented itself late last year when Ben Bernanke and the Federal Reserve announced they were tying the latest round of quantitative easing not to a set period of time or set amount of funds, but to an unemployment rate target. The move puzzled many analysts at the time, as the unemployment rate has never been within the mandate of the Federal Reserve. In fact, the privately owned central bank doesn't even possess a direct mechanism for influencing the number. The move was perfectly understandable, however, to those analysts who understand that unemployment figures are one of the most flagrantly manipulable government-issued statistics, subject to all sorts of arbitrary definitions in the meaning of the term unemployment itself. One of the premier statisticians keeping track of the real unemployment rate in the US is John Williams of shadowstats.com. In 2009, he appeared on the Corbett Report to discuss how this figure is manipulated.
If you ask the average person whether or not he or she is unemployed, it doesn't take too long to get a response. The average person knows whether he or she is unemployed. They don't have to think about it. However, if you think you're unemployed, that may not necessarily match the government's definition. The government publishes 6 levels of unemployment. They have a level U1, U for unemployment, up through U6. What's standardly considered unemployed by the government is that they haven't looked for work in the last year. The reason they haven't done that is that there are no jobs to be had where they live. Well, back in 1994, all these series were redefined, the questions were redefined, and up through that point in time, a discouraged worker had been considered someone, who, again, was without work, willing and able to work, but hadn't looked for work because there was no job to be had. There was no time limit on it. You could have been discouraged for 2 years. You could have been discouraged for 5 years. Didn't make any difference how long you hadn't looked. At that time, it was redefined that if you hadn't looked for work in the last year, you were just considered discouraged. But if it was more than a year, if you hadn't looked for work in, say, 2 years or 5 years, you were no longer counted. And that knocked several million people off the rolls of the unemployed, the broader measures of the unemployed. I estimate what that number would be now if they still counted the discouraged workers the way they were counted back in 1994 and before. And on that basis, I would say that the broad unemployment rate is probably around 20%. If you went around and just asked people, are you unemployed or not, the response you'd get would be in the 20% range.
As flagrant as the manipulation in unemployment statistics has been, perhaps even more brazen in recent years has been the manipulation of stocks and equity markets. Economic commentators are again pointing to all-time record highs on the Dow and other major stock indices as sure signs of economic recovery. And the mainstream talking heads are reporting the moves in these markets with all the breathless hyperbole of excited children. What many who are living through this age of jobless recovery know all too well, however, is that these markets, too, are hopelessly manipulated, and that the trading taking place in these markets is subject to the very same parlor tricks that define the unemployment statistics. What many may be surprised to learn, however, is that government manipulation of these markets is on the record and openly admitted. On October 19, 1987, stock markets around the world crashed, from Hong Kong to Europe to the US. The Dow Jones plummeted over 22% in a matter of hours. Ostensibly in response to this crisis, President Reagan signed into law Executive Order 12631, establishing a body formerly known as the President's Working Group on Financial Markets. This body, famously dubbed the Plunge Protection Team by the Washington Post in 1997, is explicitly mandated to maintain investor confidence in U.S. markets through whatever action it deems necessary. The group and its actions are shrouded in official secrecy, but its actions have long been identified by independent market analysts.
Just keep your eye on the last hour of trading. These are all intraday charts. This is from February 22nd, 2008. In the last hour of the day, everything is popped up. That's the Dow Jones Industrial Average. The next chart is the German ETF. Same day, 3 o'clock, same pattern, big volume starts. Guess who? Somebody's always out there buying. This is the Mexican ETF. Chinese ETF. What time is it in China at 3 o'clock? New York Standard Time. Isn't it about 3 o'clock over there in the morning? I don't know what was happening, but it sure took off. And look at that volume, too. Wow. Incredible. Incredible what these people do.
In 2011, I had the opportunity to talk to the late Bob Chapman, the economic analyst behind the International Forecaster, about the manipulations of this plunge protection team and the active collusion between government and the big traders in these market interventions.
Well, first of all, you have to believe that the markets are manipulated. It's in your face if you're watching it all. So that has to be a given. You have to understand that your government and the people who control it, they are manipulating every market 24/7, and it's legal. And the Working Group in Financial Markets, which is directed supposedly by the president, which of course it's not, was an executive order signed by Ronald Reagan in August of 1988 after the collapse in the stock market on October the 19th, 1987. And that was the excuse. And I watched the markets. And being an ex-trader, I look for the rhythm of the markets. And the markets are an art form. There's nothing scientific about them. Those people who are using algorithms only have them work because their 16 computers are right next to the New York Stock Exchange computer, and they're front-running every trade in nanoseconds. That's how they can get away with it.
Just as in all other areas of life, it is a truism that those things which are suppressed in one place tend to rise to the surface unexpectedly elsewhere. Such is the case with market manipulation. Although it is relatively easy for the federal government and institutional investors to send prices up or down through relatively straightforward manipulation, it is more difficult to prevent those interventions from becoming visible in other parts of the economy. One of the first places one would look for signs of tampering in equity markets would be commodities, goods which are physical and quantifiable and thus harder to fudge or play around with. And amongst commodities, precious metals like gold and silver have long held a special place in showing signs of currency manipulation or market intervention by spiking in value during periods of currency debasement and falling during periods of true economic growth. Given that gold has been unable to break through the $2,000 an ounce level and has recently fallen back under $1,600, we are left with two options. Either the economy is truly growing and thriving as the government says it is, or these markets too are being manipulated. Sadly, if not surprisingly, the latter turns out to be the case. Gold market analysts have long pointed to the increasing amount of gold stocks, ETFs, and other forms of so-called paper gold in the market. In 2010, Adrian Douglas estimated that there were about 45 paper claims for every ounce of physical gold in existence, meaning that the true price of gold was closer to $54,000 an ounce. Beyond this simple price suppression technique, however, are the ways that large traders use the gold carry trade, futures markets, and other methods to keep precious metal markets trading below their real values. In startling testimony before the Commodity Futures Trading Commission in 2010, Bill Murphy of the Gold Antitrust Action Committee laid out a blistering expose of the systemic manipulation of the precious metals markets with the participation of some of the highest-ranking economic officials in the U.S. government. As an executive at Goldman Sachs in London, Robert Rubin developed an idea to borrow gold from central banks at minimal interest rates, around 1%, sell the bullion for cash, and use the cash to fund Goldman Sachs' operations. Rubin was confident that central banks would control the gold price with ever more leasing or outright sales of their gold reserves, and that consequently the borrowed gold could be bought back without difficulty. This was the beginning of the gold carry trade. When Rubin became U.S. Treasury Secretary, he made it government policy to surreptitiously operate an identical gold carry trade, but on a much larger scale. This became the principal mechanism of what was called the strong dollar policy. Subsequent Treasury secretaries have repeated a commitment to a strong dollar, suggesting that they were continuing to feed official gold into the market, more or less clandestinely, to support the dollar and suppress interest rates and precious metal prices. Forced to deliver the rest of his testimony at breakneck speed to read the full remarks into the record in the 5 minutes allotted to him, Murphy continued.
God has evidence there are huge physical short positions in the gold market that cannot be covered. Growing stress caused by burgeoning physical demand is threatening to lead to a price explosion, which restore to the markets the balance that regulations failed to maintain. In our view, the COMEX paper market will become dysfunctional.
You can just try to finish up.
We're finishing up. With force majeure having to be declared as the concentrated shorts are unable to deliver on their obligations. We urge the CFTC to report fully and candidly on these markets and take appropriate action. Thank you.
Thank you. I want to thank all of our.
In 2010, I had the opportunity to interview Bill Murphy about the Gold Antitrust Action Committee and the gold market manipulations they have uncovered.
Well, we were formed by myself and Chris Powell, Secretary-Treasurer and editor of the Daily Newspaper in January of 1999 to expose the manipulation of the price of gold and silver too. Initially, we realized that we thought it was just the bullion banks like Goldman Sachs and J.P. Morgan Chase and so on, but as time went by, another year or so, we realized that the government was very much involved, and that included the Federal Reserve, the Treasury, the Bank for International Settlements, the IMF, and so on. And it's been quite pervasive, and of course, gold's been fixed and rigged for many times over the last 80, 90 years, or at least the last 80 years, and it's no change now, except it's being done surreptitiously.
That's right. Well, let's talk a little bit about the mechanism by which that's done and who you believe is behind this.
Well, yeah, Goldman Sachs used to be the ringleader, but all of a sudden we can't find them around anymore. But it's the bullion banks, and along with the government, and it's very simple actually in the way they do it, although some of the details are complicated. Is that the bullion banks will borrow gold from the central banks and in a clandestine fashion feed it into the marketplace. And in the meantime, their derivative traders, right now the big ones are with high concentrations in short position gold and silver, HSBC, a bank, and J.P. Morgan Chase. And what they'll do is they'll do it in concerted action, go after the futures market and go after the longs in the market and to flush them out. And they've been, even recently, we've had just straight down moves, and markets just don't trade like that all the time. I mean, if you look at the gold market and silver market, they just look like waterfalls. And we know for a fact that this is being done because we exposed this at this CFTC hearing on March 25th, in which a whistleblower, Andrew McGuire, had been in contact with the CFTC since last November, and this was on, as I said, March 25th of this year, and he told them when they were going to raid their market. And they would tell all their buddies, here's what's going to happen, and other institutions, and then they would go ahead at the same time, and the specs would get slaughtered. And this is against the law, and this is why we have antitrust laws in the United States.
The picture that is being painted here is one of a thoroughgoing fraud. In fact, even in this relatively short and necessarily incomplete expose, we have the sense of a fraud so large and so ensconced in the marketplace that it would be impossible to perpetrate without the active collusion of the government regulators themselves. Sadly, as the existence of bodies like the Plunge Protection Team and the failure of the CFTC to prosecute demonstrable market manipulation shows, this type of thoroughgoing collusion is precisely the case. This leaves the average working man or woman in the grip of a seemingly intractable problem. They have been told all their lives to entrust their savings to the financial experts, believing that a healthy portfolio of stocks and bonds will protect and even grow their wealth so that there will be a nice nest egg left over for their retirement. As this economic house of cards begins to topple, however, people will find themselves in the exact same position as the Romans under Diocletian, or the French of the Revolution, or the Germans in the Weimar Republic, or the Argentinians under the collapsing peso, having their entire life savings wiped out seemingly overnight. The only real protection from this, of course, is to withdraw our investments from the system that is perpetrating this fraud, from the stocks and bonds and traditional reserves of the fraudulent market. Instead, people around the world are beginning to learn the importance of investing in land and other physical assets. But perhaps more importantly, the need to invest in their local communities, in alternative currencies, in cooperatives and other institutions that have nothing to do with the actions of the fat cats on Wall Street or the political puppets in Washington. And until that realization happens on a mass level, people will continue to operate in good faith in the reality of this economic wonderland, never understanding the systemic collapse that is awaiting them.
By definition, a bank is always indebted because it has liabilities and has assets, and its liabilities are much greater than its assets. But the situation is when those debts become unsurmountable, and they become unsurmountable due to the creation of derivative debt, it's then that the big banks, the mega banks, will use their power to target the lesser banks, and they can do it at will. They can select them, and they can plan it in advance, and then they will trigger the demise and the bankruptcy of those lesser banks, take them over or close them down. So that is the scenario. We're not dealing with a situation where, let's say, the depositors of JP Morgan Chase or HSBC will be victims of deposit confiscation, because immediately that would be a run on HSBC or JP Morgan Chase. There may be selective actions of that nature, so that the candidates for this policy, because it's a policy of confiscating deposits. It's illegal in several countries. It goes against the constitution in many countries, particularly in Cyprus. But that selective process of confiscating deposits is there to trigger the demise of lesser financial institutions, and thereby trigger a mechanism of centralization of money capital nationally and internationally.
As Professor Chossudovsky goes on to point out in his article on the subject, The Confiscation of Bank Savings to Save the Banks, it is no coincidence that this bail-in regime is being formalized first in Canada. The Financial Stability Board is an international body coordinating the work of national and international standard-setting bodies for the financial sector. It sprang from the earlier Financial Stability Forum, itself a creation of the G7 in 1999, and includes bodies like the Bank for International Settlements among its member institutions. The FSB is currently chaired by Mark Carney, the current governor of the Bank of Canada, who is set to take the reins of the Bank of England in July of this year in a highly unusual move. Before beginning work for the Canadian Department of Finance, Carney spent 13 years at Goldman Sachs, where he was involved in a 1998 Russian financial scandal, with Goldman advising the Russian government at the same time as it was betting against the country's ability to repay its debt. As critics like Matt Taibbi and others have exhaustively documented, Goldman Sachs has been at the heart of every major market manipulation in the U.S. since the Great Depression, and has been the key cheerleader for the austerity measures that are currently tearing the Eurozone apart and creating the banking crises in Cyprus and other European countries. The path forward on the highway toward the coming economic collapse is, needless to say, perilous. Worse yet, all of the off-ramps that are being constructed to lead depositors and investors to safety during these difficult times are themselves false roads leading to dead ends constructed by the financial oligarchy. But as with every such fork in the path, there is an opportunity for the public to educate itself about what is really happening and discover a genuine alternative route on this economic roadmap. The entire existence of the bail-in paradigm makes plain an uncomfortable truth that the banking establishment has struggled to obscure for generations. That bank deposits are not piles of money sitting in bank vaults to be drawn upon as needed, but unsecured loans being made to banksters who use that money to gamble on exotic financial instruments that themselves are threatening to destroy the world economy.
The Federal Reserve is no more federal than Federal Express.
You try a hide and destroy a freedom, man. You seek agenda, we know you anti-American. You come forward American Constitution. 1913, corrupt up in the system. Devalue dollar, hyperinflation. The Federal Reserve, controlled by Lucifer. He can see you lying.